they've had a nice little run here. It's still going to be a very small fraction of what a deposit like that is typically traded for. In a normal market, a 7 million ounce plus deposit should sell to a major for $150 an ounce or more. So they're probably trading at about a tenth that or thereabouts. The other thing I like about Banyan and their team is they're very technically oriented.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Brien Lundin, longtime editor of the Gold Newsletter and host of the New Orleans Investment Conference. With decades of experience in gold, silver, and resource markets, we'll be getting insight into macroeconomics, mining stocks, and wealth preservation strategies. This year, I will be again at the New Orleans Investment Conference with the missus. Our tickets, flights, and hotel are already booked, and we're looking forward to connecting in person. Brien, thank you for coming back on the show.
Great to be with you, Steve.
Yes, sir. I have been excited. Been looking forward to this one as well. I'm really looking forward to your conference. You and Rick have a running joke about who's got the best conference every year, and Gloria says that you win hands down when it comes to the food. The food at your conference is amazing.
Well, that's certainly one of the big attractions for our event. You know, New Orleans itself is a star of our event. It's a special place to be. And I think that adds to the ambiance of the entire event. It's kind of like going to a destination wedding or something, or some kind of a exotic destination with your friends, etc. Everybody's in a fun place. Everybody's out of their normal environment. Everybody's sharing their ideas. There's lots of ideas being floated around from the stage and from the audience. So it's really exciting. It's something that has to be experienced to be really understood. And we work hard to bring, the best of New Orleans in food and music, and what really makes this a special place into the event itself. So yeah, food's great.
It is a lot of fun. I enjoy it. I like the companies that you got there a lot. Go ahead and kind of give us a preview. If no one's been to your conference before, what can they expect when they go?
Well, I mentioned the audience. It's a very smart, sophisticated, successful audience. It's investors who are somewhat mavericks. They chart their own path. Uh, they have their own ideas, make up their own minds, and they're very eager to share their thoughts and ideas. I get as many of these companies I talk to on a weekly, daily basis, as many events as I go to. I get great ideas from our attendees, so that's a big part of it. From the stage, you get, I think, the best roster of speakers you'll find anywhere. I'm a big fan of all of our speakers, so I am a kid in a candy store every year, getting to pick who I think are the best thought leaders out there and bringing them to grace our stage. And, if you look at it, I encourage everyone to go to neworleansconference.com. We keep adding speakers. We've added a couple more in the last couple of days. Peter St. Onge and Jim Bianco, just added them to our speaker list. Oh yeah, there you go, sharing that. If you go to the if you go down, yeah, there you go. You should show most of them right there.
George Gammon.
It's a great lineup of speakers. I don't think you're going to see anything like it anywhere else. We have literally dozens of the top people out there. Matt Taibbi, I think, is the most important journalist of our generation, exposing a lot of what's been going on, concerning things that's been going on in government and media. So we start off, or we start at the top, geopolitics, macroeconomics, and we drill down into every market. We examine the economy in a lot of fun panels, and we drill down into metals and mining. You know that we have a long history, really the longest history in the industry, in focusing on gold, silver, the monetary metals, sound money, the mining industry. This is our 51st annual event, so we've been around longer than anybody, and we have a legacy that we try to burnish every year, and it's like nothing else out there.
Last year was a lot of fun. This will be my second year. I really look forward to it. One thing that's really cool for me is, I'm like you right now. I'm sitting in an empty room, you know. But when you go to these events, you get to meet the listeners and the people that are, behind the scenes. And it's an honor, and I enjoy it. And getting to meet all your speakers and interview them as well. And on top of that, the icing on the cake, all the companies that are there. My God, what a good outcome for your brokerage account. I'm really looking forward to it. We'll put the links down below. I hope to see you guys there.
Yeah, and the junior mining industry is famously, excuse me, famously inefficient, and that's to your advantage because you can find opportunities that the rest of the market or the mining share market even just temporarily overlooks, and you can talk to these companies. I can't tell you how much, I can't adequately express how much you can get by talking to a company junior mining CEO or their VP exploration and seeing what they think, asking them questions, looking them in the eye, and the color that you can get. You're not going to get inside information or anything that's not public knowledge. All of these companies, especially the ones at our event that are kind of the cream of the crop, don't do that sort of thing, but they will explain why they're exploring here, and you can see the excitement in their eyes. You can ask them how much of their stock do they own, are they buying? And that's where you can really separate the wheat from the chaff and find tomorrow's winners really at this event.
Super excited, Brian. Can't wait to do it. A lot of fun. Okay. Big picture view. What is your macro view of the world economy and financial markets today?
Well, my big thesis is the same as what I've been talking about really from years now, is that we've had decades of ever easier money, 45 some odd years now since Paul Volcker killed off inflation at the end of the 70s. And the interest rates have been progressively lower, except for this past recent experiment in trying to raise rates, and really feeling the effect of what that means. And what I've talked about for years is the fact that with this ever easier money, we've had the accumulation of ever greater debt to the point where we cannot have normal rates of interest any longer, because the cost to service the debts would crater the budget and really the economy. That's what we've seen of 1.2 or thereabouts and $1 trillion in debt service payments every year right now. So they have to desperately get interest rates down to manageable levels going forward because debts are so high. We have to have negative real interest rates. In other words, the currencies have to depreciate more quickly at a greater rate than the amount of interest you're paying on the debt, or everything falls apart. That's why we are going to see lower interest rates in the future. Now, one of the things that did surprise me, and I think everybody, was the fact that following the Russian invasion of Ukraine, that the severe sanctions that were placed on Russia really woke up central banks into trying to gain some independence from potential dollar weaponization, where the gun may be pointed at them at some point in the future. So they've been trying to gain some independence by buying gold hand over fist at record levels. Now we've seen that those gold purchases from central banks taper off a little bit in recent months as the price has risen, but it's still programmatic buying. They still buy a certain amount every month, and they are still building their gold reserves. So that's a trend that I think took everybody surprised, but it has really important implications for investors in that mining stocks aren't bought by central banks. Silver isn't bought by central banks. So those traditional levers to gold have lagged in this bull market. We're starting to see that reverse, and I think that creates an opportunity where Uh, you have a bull market in metals, but you have these levers on that bull market in gold that have yet to run. So it's an extraordinary opportunity that I believe is unique in the history of gold as an investable asset. So it's a remarkable time to be a gold and silver and mining stock bull, I think.
Okay, so we have had decades of easy money, and all you got to do is look at the Fed funds rate to see that just getting cheaper and cheaper as the debt goes up and up. We're up to 1.2 trillion just in the interest cost of servicing that debt. Negative real interest rates, meaning that, if you want a bond or something, inflation is outpacing that, so you're actually losing money. This has led to a lot of central banks around the world buying a bunch of gold, which has given gold a real run. But we haven't seen the mining stocks have that run yet, and that's because central banks don't buy mining stocks; they buy gold itself. So you see an arbitrage right now where gold's had a nice run. The mining stocks should have a nice little catch up here.
Yeah, the some of the major producers have doubled, in this bull market, so they have reacted to some degree. But if you look at, in earnings per share, if you look at earnings per book value, you look at all the standard valuation metrics, they are still at the very low end of their traditional range. So it's hard to say that a stock that's doubled is still a value, but it really is. And they are, the major miners are. Now, what we've seen is that that's starting to go down the food chain into the intermediates, into the juniors. This summer has been very interesting. Gold and silver had their typical summer doldrums, not so much with the correction, but kind of a trading range that they seem to be coming out of now. With typical seasonality. But what was interesting to me is that while we didn't have a rollicking bull market in the juniors who wanted to raise money were able to do so on their terms, uh, which is something we haven't seen for a long while, especially during the summer. So we're really set up now that I believe gold and silver are rebounding from their summer doldrums, that the mining stocks at juniors are fairly well cashed up. The drills are turning, and I think we're going to have a really fun fall for those who are positioned in the sector.
Okay. Um, Big picture gold. Do you mind sharing your screen on the gold chart?
Yeah, one of the things that I look at or have been looking at, and really so much more during this bull market. If you can see my screen, you should
Yeah.
be able to see gold's Bollinger Bands. And this goes back to, and actually on this chart, I probably need to go back a little bit longer and go maybe
Okay, so this
back to
just
the
to
beginning.
emphasize here, the yellow is the price of gold, the blue lines are the Bollinger Bands, and
Yeah,
basically when it gets to kind of an extreme on one side or the other of the Bollinger Bands, that could tell you that it's a little overbought or oversold, right?
yeah. And the bottom panel shows you the width of those bands. And when they've expanded and the width is maximized, it's typically presaged or predicted an imminent correction. And when the Bollinger Bands pinch, which is those bottoms, if you look in the bottom panel, when the width has collapsed, then that has often predicted a breakout. So Bollinger Bands are a measure of volatility. So when volatility is collapsed, it usually means that we're going to have a breakout in either direction quite often, and typically in the same direction as you've had before. Now, what's been interesting about this bull market is that the corrections have not performed as you would expect them to from a strict technical standpoint. We haven't had much in the way of price corrections. We've typically had a drop off in volatility, range bound trading, a pause in the ascent, and not so much a really cleansing price correction. And then we've taken off in another rally. What I've done in this chart is to go and mark the bottoms in the bandwidth with green uh, green bars, green lines,
Oh,
the
okay.
peaks red. And as you can see, it's been a stop go kind of an indicator.
Yeah.
In November, we had a weird time, an exception to this kind of pattern that had been set up. In that post the presidential election, we did have a pinching of uh, of the Bollinger Bands, but it was more because volatility had kind of collapsed, but then they expanded because of there was a big sell-off. In other words, volatility can increase on the downside as well. So if you take that period out post the election, it's been fairly regular and fairly consistent. Now,
Yeah.
what we see here is that we've been range trading in the summer, and volatility has come down, and it's been another kind of an exception. But at the very end of this, we have volatility has collapsed to the levels on the bandwidth that we have had before that have come right before a breakout. So
Interesting.
I think this has been an extended downturn in volatility, and a number of other analysts have pointed to the pennant formation that gold has formed, that we're starting to see a breakout. I think we're going to start to see an increase in volatility again, an increase in the bandwidth for the Bollinger Bands, but this time on a new rally. And I think if you look at seasonality, it works there as well.
Yeah, you and I are looking at different indicators, but coming to the same conclusion, which makes me feel a little better. That's
Yeah,
cool.
and this is just one of the tools. If you look at that, like I say, if you look at the pennant formation, we have narrowing volatility, we have the price narrowing, the price range narrowing. And if you overlay that with the fact that this is typically from a seasonality standpoint when we would have a breakout, it's all pointing to, the window is closing as far as an opportunity to get in before we get a new fall rally.
Yeah, and gold recently had, well, recently in the last, I don't know what it is, it's a year and a half or so, it's kind of had these stair steps where it like goes up and it kind of forms that pennant or bull flag like you're talking about, then it goes up to the next level and does that. And I feel like we're just kind of at the end of this bull flag slash pennant before we get a breakout up to the next.
Yeah, and again, we haven't had the typical price corrections that you would see because this market has been driven by central banks who are just going in the market on a regular basis, and every month they're buying on a not completely price insensitive, but largely price insensitive fashion. So what creates those sharper peaks and valleys in a typical market are is the swing and emotions of people, of investors. They get euphoric, they get, they get washed out. You don't have those emotional swings in a market that is largely being driven by institutions that are just buying every month on a steady basis. So that's kind of tempered the swings, and it's meant that we have not had those steep price corrections that you typically get in a bull market.
Yeah. Okay, let's move on. I'm going to share my screen here. Let's move on to silver. And unless you got a silver chart you want to pull up, I was just pulling up a
No, let's see
generic
what you
one
have.
here. Okay. What do you see on price action for silver? This interview goes live tomorrow. We're at 38.57 at the moment. What do you see here?
I see $35 as being the big breakout point that we've come back and tested once or twice.
Hmm.
It's fairly far below us right now.
Yeah.
And although we've had some steep corrections, we have not had anything that's really, um, tested that $35 level. Certainly not broken through it, and we're still, well above it. Also, we're seeing a rebound. We had a bit of a decline at the end of July, but so far this month we're rebounding, and
Hmm.
as we speak today, we're having another good market. I mean, good day in silver. I
Yeah.
haven't checked the price in the last couple of hours, but we were having a really nice run in silver, and still are, over 1.5% today. So I think silver is taking aim once again for $40. And once we get there, that's another, obviously a big number. But I think $50 is where we start looking again. And that's the old nominal high. There's really, nothing much between silver at this point, between silver and today's levels and $50.
Okay, so you're kind of seeing like 35 as maybe a floor, or is that?
Yeah, I think it's very strong support right now. If you see where we went and tested it,
Yep.
I guess in June, but since then, not a really serious test, and I think that's very strong support at this point. And the next target is within reach. We could get to that in a couple of days from this standpoint if we continue this rally.
Yeah, I'm seeing the same thing. I'm seeing like 40, $41 is kind of the next level up, and then a lot of support here around 35, and then even more right here on this 200-day moving average around the 33 level or so. But okay, interesting. Any other commodities on your radar?
I like copper. I thought that big drop we had in copper
Hmm.
as a result of the tariff, I think that's created a tremendous opportunity because, tariffs on finished copper goods will have an effect on the supplies of copper, but it won't have an effect on the demand. I think you can't get away from the demand for copper. If you look at the fundamental drivers, the baseline, the base case supply demand story for copper, not talking about electrification of vehicles, not talking about the rebuilding of the electrical grid globally. If you just look at the base case for copper, it was already going into a supply deficit. If you add those other factors in, if you also add in now the AI data center build out, where about 6% of the capital costs of a data center is purely for copper, you're not going to put a crimp in those sources of demand. You're still going to have one of the steepest demand curves that we've seen for any commodity in the history of modern investing. It's still there, and you cannot innovate around copper. So, if you're going to constrain supplies against a demand curve that you can't alter, I think all you're doing is putting greater price pressures on that commodity. So this is really a gift, this setback in the copper price. I think it's a gift for investors. It's a chance to get into some of the bigger copper producers and some of the copper juniors.
Okay, I gotta give you a, personal thank you because you were one of three people. You, Adrian Day, and Joe Mazumdar said basically buy copper on pullbacks, and that's exactly what I've been doing with the green arrows here whenever we had a pullback. And your advice was pure genius, my friend.
Well, I'm certainly not the only person out there saying it, but I think, copper is going to double over the next 5 years. And it's just one of those set it and forget it investments. Don't get caught up in the daily swings, but recognize this long-term fundamental trend.
Yeah, yeah, yeah. Okay. You mentioned copper juniors. Do you have any on your mind at the moment?
I had a talk, an update with Gladiator Metals.
Okay.
It's an extremely non-promotional company. It's been in our gold newsletter portfolio for a while. It's done very well in that portfolio. I think we're up, what are we up? We're up 152% so far on it.
Oh, wow. That's had a nice run. Yeah.
It is still, and it's unfortunately, it's one of the companies in our portfolio that I do not own yet due to my policies of not front running our recommendations. I've never gotten back around to buying it. And it's performed very well, but they are going a long way toward understanding their project, high grade, structurally controlled over a very long strike length. They're understanding it. They're getting really super high grades in building tonnage. So really like that story in the copper space.
Okay, Gladiator Metals. All right, thank you. Okay, got some listener questions here. Javier wants to know, which commodity would you be most bullish on in 2026 and 2027?
Well, gold and silver, monetary metals. Silver again, naturally leverages gold, and I think it's coming into its own. Obviously, I like gold. We just talked about copper. I think again that's a set it and forget it metal that for entirely different reasons than the monetary metals. We're very fortunate at this point to have a bull market in, I think, base metals in general, copper specifically, and monetary metals for entirely different reasons. So yeah, I think you need to be positioned in both those.
Okay, gold, silver, and copper.
Yeah.
And base metals. What other base metals do you mean beside copper?
Well, you have similar supply constraints. You have the same things in zinc. You have the battery metals, of course, which again, I would throw copper in there is the preeminent one because for most of the other, really for all of the battery metals, lithium, cobalt, and the like, and you can innovate around them to some extent. Maybe not completely eliminate, but you can get different technologies that emphasize or de-emphasize. You got to have copper because at the end, that's the motor windings, that's the transmission of the energy of the current, and you just can't get around it.
Yeah, yeah. Okay. When you mentioned that 6% of the cost of a data center is for copper, am I getting that right?
That's what I saw somebody post the other day.
Okay.
I would love to have a source to back that up, but other than a social media post, I have nothing else to back that up.
Okay. That
Sounds
sounds like
about
a
right.
similar. Oh, sorry. That sounds like a similar story like uranium. The basically what it's saying is that the cost of the underlying commodity is such a small portion. It's not like they're going to stop building the data center if that cost goes from 6% to 10 or something. You know what I mean? They're still building the data center regardless.
Yeah, and that's an important thing to consider for a lot of these metals. They don't make up that much of the end cost of the product, the end price of the product. Silver is a great example of that. 70% of the mined silver comes as a byproduct of other metals. So, if the price rises, it's not necessarily going to increase supply. And by the same token, the metal itself, when it gets thrown into a solar panel, it doesn't really uh, add that much to the end price of a solar panel. So they're still going to throw it in there. And if the price doubles, they're still going to use it in the solar panel. Conversely, if the price doubles, it's not going to bring a lot more supply onto the market because it's only typically just a byproduct of other metals production. So it doesn't affect demand, it doesn't really affect supply.
Yeah. Yeah. Okay. SB wants to know, hi, Brian. I'm a subscriber to your newsletter. You own some of your recommendations, but not all. I'd like to know what makes you buy versus not buy your recommendations. Thank you.
Yeah, I alluded to that. I may be the only newsletter writer left out there that doesn't front run his recommendations. Not that a recommendation affects in Gold newsletter or our alert service doesn't necessarily affect the price. Usually it does, but not to a huge extent. That may be changing now that we're in a bull market, but we have a long-standing, multi-decadal tradition of not front-running our recommendations. It's kind of an old school business model that just about every other newsletter writer has gotten away from. Most writers now say, this is what I'm buying, this is what I'm doing, see if you want to follow along with me. So that creates a bit of a constraint. Now I still invest in private placements. That's not in the open market, doesn't affect the price. But there are lots of companies that I invest in private placements that I don't end up recommending in Gold Newsletter because, I think I'm a bit crazier than some of our average reader should be in some respects. There's a higher bar to clear for me that before a company gets recommended in Gold Newsletter. But as subscribers will see from the size of our portfolio, which is grown to really almost an unmanageable extent, I do follow a lot of stories and recommend a lot of companies because if I think a company is about to rise significantly in value, I want to tell our readers about that. Now, our average company in our portfolio right now has doubled in value. So, it's worked out well. We still have some companies that are negative, but we have others, that are still in there. They're 10 baggers. So it averages out to, in a bull market like we have right now, extraordinary performance. So it's hard to look at some of these companies and say, well, I really want to cut that one because I think they're all going to rise. So yeah, I can't buy all of them. I just don't have the available funds to buy all of them. Some of them have gotten away from me, quite frankly. So yeah, I think that's it. Really, I wish I could own them all.
Okay, all right. When you're human and you only have so much bandwidth. Um, okay, Darren wants to know. This is an interesting question. He says, I'm 50% physical gold and 50% individual miners, and I'm considering selling some gold to buy more silver miners in my regular brokerage account. I'm 60 years old. What would you guys share as an opinion?
Well, I would share the opinion and the fact that I'm not a registered investment advisor and I can't give him individualized investment advice.
Ditto.
A walking disclaimer, Steve, here. I can't tell him what to do. I have know nothing about his situation, and if I did, I couldn't give him individual advice. I would say that, um, I would not devote my entire investment portfolio to metals and mining. My personally, I'll give you my advice. I am over 60. I have real world investments, primarily my retirement accounts that are, in the mainstream market, and they have been, and they've done very well, obviously. And then I have my fun stuff, well, more than fun. I have my insurance, physical metals, and I have investments in the sector because, I have a bit of an advantage in the sector in that I know everybody or just about everybody. If I don't know somebody in the mining sector, I know their best friend, and 1 degree of separation from anybody. I learn about things. I swim in this very inefficient market, play in that sandbox, and I have a good idea of what should work. Nothing's a guarantee. So my investing portfolio is divided, I would say now roughly 50-50 in retirement accounts that have been in the mainstream markets, and then metals and mining. And that's where I feel comfortable. But I think that's probably a bit more aggressive than most people should be.
Okay. Let's say, and we're just guessing here, Darren, because we don't know, but let's say he's talking about his gold portfolio, which is
Mm-hmm.
20% of his account. And let's say that half of that is in like PHYS, so it's a mouse click. And then the other half is in GDX or something for the miners. Like, what would, if you were going to sell one portion of that, the PHYS or the GDX, to put into silver miners, which way would you go?
Well, I would say again that so much of it depends on their individual circumstance because physical metals I look at not so much as investments unless you've done something to raise the risk profile and raise the leverage, like investing in an ETF or spot physical metals on margin in your account or something like that, or um, or yeah, just margining an ETF. Unless you've done something like that, then I look at the physical metals as insurance. So two reasons to hold metals is insurance and as an investment. As insurance, you're taking some portion of your liquid wealth, and instead of putting it in dollars, you're putting it in physical metals to insure against something you know is going to happen. Those dollars are going to purchase less in 5 years or some period of time. And physical metals have historically protected against that. So I look at the physical holdings as that insurance component. I look at the mining stocks, and perhaps silver in some degrees leveraging gold, as ways to invest in the sector and gain some torque on that macroeconomic trend that you recognize. So, there are people who say that of your total investing portfolios, people said historically 5%, maybe 10% in physical metals as insurance. Some people have back tested it using modern portfolio theory, trying to find that efficient frontier of optimized maximum risk adjusted reward. That shows even higher component for gold because over the last 25 years, gold has outperformed the major stock indices over that time period. And I think I'm not a proponent of cherry picking beginning and ends and looking at performance of various asset classes, but you can't deny that gold has done a good job over the past quarter century. So there is an argument for even holding more than 5 or 10% of your wealth in physical metals. Again, I don't know what this gentleman's individual story is. I couldn't advise him on that. But I would say that generally speaking, if you have physical metals to a portion where you can sleep well at night and they give you comfort that you have a portion of your wealth insured, then I would focus for torque for investing more in the mining stocks. I know that's not an answer. So,
All right. All right, Darren.
sorry, Darren.
Okay, one I've been wanting to ask you about Banyan Gold. Tara Christie, I first met her at your conference.
Yeah.
Then I met her again out at Rick's, and I interviewed her again out there. And maybe I'm wrong, but it looks to me like they found their starter pit.
Yeah.
Talk to us about Banyan.
Yeah, I was hoping that they would find their starter pit. That's been the thing that they've been looking at, let's get a 1 gram per ton or better. And it looks like they've done much better than that in finding where they would start. And they don't have the economics yet, but when they do, they're going to, I think, be exceptional for that reason. I'm not sure whether they're still selling for under $10 an ounce in the ground. They've had a nice little run here. It's still going to be a very small fraction of what a deposit like that is typically traded for
Mm-hmm.
in a bull market. In a normal market, a 7 million ounce plus deposit should sell to a major for $150 an ounce or more. So they're probably trading at about a tenth that or thereabouts. The other thing I like about Banyan and their team is they're very technically oriented. Tara has done a great job of identifying what the check boxes are that a major is going to want to have checked off, how they can de-risk it from a technical standpoint, from an ESG standpoint, environmental, all across the board. And they are steadily checking off all those boxes. So this thing is going to be buttoned up tight, I think, over the next 6 months to 12 months and really be packaged well with still a lot of upside in it. They haven't found the intrusive engine for all of this gold that they have yet. And so that's something that's still a little mystery left in the deposit, even though they're over 7 million ounces, probably at this point over 8 and going for 10. Um, I just think it's one of the premier deposits out there. I do own this one personally, but not enough in my mind because I think they are a great play because I think the market has overlooked these big resource companies, these juniors that have identified large resources that have not been re-rated in light of what the gold price has done. So there's huge potential, I think, in that one, as well as a number of other companies that have historically been looked at as optionality plays. All the optionality plays are now well economic, if not wildly economic, and they have yet to be repriced after this big run in gold.
What are some others that you have on your radar?
Seabridge is, the preeminent optionality play out there. I
Yeah.
don't think it has been revalued in accordance to what the gold market has done. It was for so long, so many years, it was the play that, when the gold price really gets up there, when gold really takes off, then at some point this will be economic. People don't realize that there was probably that hurdle for economic viability for Seabridge probably happened around $2,100 or $2,200 gold. Now you still have a tremendous capex involved in developing that project, but when we get the big money into the sector, when we get the hedge funds and the big institutions truly coming into the sector, they toss around $1 billion tickets like it was nothing. And what my point being that what is a huge capex number for us in the mining industry is almost a rounding error when you look at the big money that's invested in technology and AI and the like. So when they come into the sector trying for either making investments, looking for returns, or just looking for security of supply, they won't bat an eye at funding some of the capex costs, that we think are extraordinary.
Yeah, in a bear market, $1 billion is a lot. In a bull market, it's not.
Not when the generals come in here and start writing those checks.
Yeah, yeah. What do you think it would take to start this off? Are we talking like 1, 2 billion
For Seabridge,
for Seabridge? Yeah, yeah, yeah.
I forget what it is, but I think it's one of those things, that's approaching $1 billion capex to build it or
Yeah.
around that. I think Rudy is looking obviously ways to stage development, but again, somebody that comes in there and says we're going to do it and writes the check, they've got decades of production. And the key with projects like that is, they've got mining lives that would go to 40 years, but
Yeah,
after 20 years the net present value falls right off a cliff.
yeah.
uh, so the key to that is getting production rates up, and so staging it can be profitable, but bringing forward that production into that 20-year mine life frame is where the real returns come in, unless it's a company that's a strategic that can think in those kinds of time frames.
Okay, okay. All right. Um, we're tapping on the hour here. Any last company you want me to pull up? Any other thoughts?
I like Prince Silver. Again, I own that one. I own a bunch of that one. It has a resource that is sizable in Nevada. Well, actually, it doesn't have a resource. It has a non-compliant historical resource that needs to be brought into compliance, meaning there's been a lot of work done already. They can see what they have and they're going to drill it. They don't have to duplicate all of the holes. They just have to validate the previous work, drill a little bit more, and bring that into a resource. So I think that's a great play on silver. I like, yeah, it's had quite a run here. So I'm not the only one who believes this, and I think it's got some more room to run, especially when you look at what silver is going to do and the amount of attention that's going to be going to the sector. I like Meridian Mining. This is another one that we got on a while back in Gold Newsletter. It's up over 100% in our newsletter, but the economics for their project are extraordinary. And they're heading straight for development. And they're not even up to their historic highs. So there's a lot of room to run. They've got a identified district level trend with other deposits that they can exploit and bring into the resource. The key there is that the early years of production pay back very quickly. So it's a great technical team, great management team out of London. They were able to raise money. They did a very large financing recently, so they're going to keep the drills going and bringing this along the pathway to development. Again, the economics are extraordinary. So I really like that one. Let me see what else. Erdene Development came out with some great news today. One of the few times in my career that I've seen drill holes reported in kilograms and not grams per ton. They've got an awful lot of gold. They have no, it is in Mongolia, but they're on the cusp of production. They're actually mining right now, not in production, but they're going to go through commissioning over the next quarter or so. Really going to spin out a lot of cash flow very shortly, and it's not priced for that, in my opinion.
Okay. I interviewed these guys out at the Metals Investors Forum in January. Will they be at the conference?
I believe they will be.
Okay.
Believe they will be. I'd have to look at my listing to see, but yeah, I think they would. They usually come. And it's a great company. Peter Ackley is the best of the best.
Yeah.
They are extremely non-promotional, and that's why I think it's flying under the radar of a lot of people right now.
Yeah. I got nothing but good vibes when I interviewed him. Brien, thank you very much. I really look forward to the New Orleans Investment Conference. We'll put your links down below. Any final thoughts? If viewers want to get a hold of you and follow your work, how should they do so?
Yeah, NewOrleansConference.com. You have the links to see our speaker roster. GoldNewsletter.com. I think Gold Newsletter is still the best value in the industry as far as newsletters. There's very few newsletters covering the sector any longer that are not, that are subscription based and not sponsor based. So, we're the oldest. I think we are at this point the longest running investment newsletter in the world. So we have a very long, bright legacy that we like to protect and protect jealously. So, every recommendation in Gold Newsletter is merit-based. There is no pay for coverage. I try to own as many stocks as I can. I physically can't, but the track record's there, and there are very few really big winners that get past us. So I think, if you go to goldnewsletter.com, I would encourage your readers to subscribe, because this is an exciting time. This is the time to be in the sector. We are beginning, I believe, another bull market run like we had in the early 2000s, and you don't want to miss it.
Awesome. We will put your links down below. Brien, thank you for coming back on the show.
Thank you, Steve. Really appreciate the opportunity.
Yes, and thank you for tuning in. Go to stevebartonmoney.com for more, and have a wonderful day.